Hi, I'm Terri Stecher in the Compensation and Benefits Group of KPMG's Washington National Tax. And I'm here today with Bob Rothery, who's in the International Executive Services Group in Washington National Tax. And we're going to be talking today about the new net investment income tax and its impact on international assignment programs. So Bob, do you want to mind telling us a little bit about this new tax for 2013?
Sure, Terry. Well, it's funny because it's not really a new tax. Obamacare, or the Affordable Care Act, brought in a couple of new taxes in 2010, but they weren't really on anybody's radar screen. So they both became effective in 2013, and now a lot of employers are really scrambling to figure out how they affect them and what they should be doing.
Well, you mentioned new taxes. Do you mind mentioning one of the other taxes that goes into effect in 2013?
Sure. Well, the other main one is called the Additional Medicare Tax, and it's actually a second bracket on the Medicare tax, which is part of FICA. Everyone pays 1.45% Medicare tax on all of their compensation, all their earned income. But now there's a second bracket. If your compensation is over a certain threshold, then you'll pay an additional 0.9% of Medicare tax. That threshold is $200,000 if you're single. It's $250,000 for a married couple. And unusually for the FICA tax, the $250,000 is taken on both of the spouses' compensation together.
But the net investment income tax isn't subject, it isn't a Medicare tax, is it?
That's correct. It's not a Medicare tax, it's not part of FICA, and it's not a withholding tax. It's simply an additional tax on unearned income.
And while we're calling it a net investment tax, it's really a tax on unearned income. Do you mind talking about that distinction?
It's actually a really important distinction because the name makes you think that it's just on investment income, but it's on investment income as well as all sorts of other kinds of income. So in addition to paying the tax on dividends, interest, capital gains, people will also be paying the tax on things like royalties, rental income, even annuities unless they come from qualified retirement plans.
Well, and you mentioned qualified retirement plans. I mean, there are some important exceptions to this tax for, qualified retirement plans, but also individual income that's subject to SECA or income from the sale of your primary home, primary residence, as well as partnership income from trade or business.
Well, that's true, but that's funny because there's an exception to the exception. When we're talking about partnership income or other business income from pass-through entities like S corporations, we have to look at whether or not it's passive income. And for those purposes, we're not looking at whether it's passive income for the pass-through entity, but rather for the individual. So it could be active business income in the hands of the partnership, but if it's characterized as passive income for the individual, then it is going to be subject to the new tax.
And I think it's important to remember that not everyone's going to be subject to this tax. So can you talk about, what these threshold amounts are?
No, absolutely. In fact, this is confusing too because they're the same thresholds, but the thresholds are applied to different things. So where the 0.9% Medicare tax, the thresholds are applied to compensation. For the net investment income tax, that's effective if an individual's modified adjusted gross income is over $200,000, or for a married couple filing jointly if their modified adjusted gross income is over $250,000.
So are you finding, employers are concerned with this tax? And then, from an individual standpoint, what are their options as far as withholding? Do you mind mentioning some of the special forms they're going to have to file?
No, sure, of course. In fact, most employers aren't concerned with the net investment income tax because unlike the additional Medicare tax, the 3.8% tax is not a withholding tax. So it's up to the individual to be sure that the tax is paid. They can do that in a couple of ways. They can either adjust their income tax withholding from their salary, changing the number of withholding allowances they have on Form W-4, or they could also just figure out how much tax they expect to owe and pay that on Form 1040-ES, the estimated tax payments that you can make quarterly. In addition, taxpayers are going to see two new forms attached to their tax returns at the end of the year. The new Form 8959 will calculate the additional Medicare tax, and the 8960 will calculate the net investment income tax.
Can you talk about, what's going to be the impact for these international assignment programs, especially if they have a tax equalization benefit?
Well, that's a great question too. And in fact, that is a significant case where employers will be concerned with the new net investment income tax. As you're aware, when a person is on international assignment, it's likely that their compensation is going to be pretty inflated. A lot of special allowances and tax reimbursements that they get are added into taxable compensation, and that may push their income above the threshold and cause them to be subject to this tax. And if that's the case, they're going to be expecting their employer to pay the tax on their behalf, and that'll involve a gross up as well. So that means that this, particularly if international assignment program has a larger population or higher income taxpayers, there could be a big incremental cost to the international assignment program, and employers may want to be budgeting for that, accruing for that, and particularly if there's contract costs that they need to be taking into account, they may want to be recalculating their program cost.
I mean, so this new tax can increase someone's effective tax rate by almost 4%.
That's right.
But I mean, when you look at what the tax rates are in some of these foreign countries, it can still be, higher than that. So I mean, if you take into account the foreign tax credit, do people end up being in the same tax position?
Well, that's causing a lot of confusion too, because the foreign tax credit is a credit for foreign income tax against U.S. income tax. And the new net investment income tax is not considered to be an income tax. So even if the foreign income tax rate is significantly higher than the U.S. tax rate, you will not be able to offset the 3.8% tax with foreign tax. So that represents a significant incremental cost to some international assignment programs.
Yeah, so I think depending on the income of the international assignee, it could have a significant impact on them.
Absolutely.
Well, I think there's a lot more to this tax than maybe people have originally thought, and individuals, especially if they are on international assignment, may be surprised when they get their 2013 income tax information. Well, thank you for talking to us today about this new tax.
Thanks so much, Terry.